When you step onto a California manufacturing floor, the stakes are obvious. You hear the spindle revving, you see the metal shavings fly, and you know there is serious capital at work. But when it comes time to sell that facility, the rules completely change. Owners of coffee shops might rely on public marketplaces and open showings. For a $15 million precision fabricator, that public approach is a liability. In the $5 to $25 million range, the process shifts. You move through private channels using curated lists, gated NDAs, and controlled auctions to protect the company's value. The common mistake is prioritizing the size of the check above all else. In reality, a buyer's capital source dictates exactly how your company will be run the day after the sale closes. Selecting the right buyer class creates the structural alignment necessary for the specific exit you've planned. To find that alignment, you have to stop asking, "Who will buy my business?" and start defining what you need the exit to accomplish. First, do you require a clean, immediate break, or are you willing to accept a transitional role in the company? Next, do you need maximum cash at closing, or can you accept a longer earnout structure to increase your total payout over time? Third, decide if protecting your staff and existing culture is a requirement, or if you will optimize strictly for the highest possible valuation. Fourth, if the deal includes real estate, will you sell the property, hold it and lease it back, or keep it entirely separate? The answers to these questions act as a filter. They automatically disqualify certain buyer classes before you ever take the business to market. The first category is the strategic buyer, competitors, suppliers, or adjacent corporations. When they see specialized equipment like this, they see turnkey capacity and immediate access to your customer base. Because they already operate in your industry, they can eliminate redundant back-office costs and route their existing work through your facility. These synergies allow them to justify the highest headline valuation. However, negotiating with a competitor introduces the risk of a confidentiality breach. If a rival reviews your unredacted margins and specific customer pricing, and the deal falls through, they leave the table with your competitive playbook. You manage this risk with a staged disclosure process. You withhold specific customer identities and granular pricing until the buyer's funding and intent are verified. This matrix shows how the trade-offs align. Strategic buyers offer the highest price potential, but they require the most aggressive gating of sensitive information. Financial buyers, like private equity groups and family offices, operate differently. You are selling to a room full of analysts who view your company as a growth investment with a specific window for resale. Their primary advantage is deep, committed capital. They move quickly and often offer the seller rollover equity. Rollover equity allows you to keep a percentage of ownership in the company. When the firm grows the business and eventually sells it, you capture a second payout. The trade-off for that capital is a rigorous institutional review. These buyers enforce a detailed quality of earnings diligence process. They will test the durability of your historical EBITDA, challenge every add-back you claim, and evaluate how the business functions when you aren't in the building. Adding this to the chart, private equity is ideal if you want a well-funded growth partner and your accounting can survive Wall Street-level scrutiny. Independent sponsors and search funds are backed entrepreneurs. Their goal is to personally operate and manage the single business they acquire. If you prioritize legacy and employee stability, this profile often matches your goals. They want to step into your shoes and maintain the operation you've built. However, the sponsor model has a specific vulnerability. Many of these buyers lack a pre-committed fund and must raise capital on a deal-by-deal basis. This can create timing risks during escrow. A deal might stall after you sign the letter of intent while the buyer secures their lenders. Looking at the completed matrix, search funds offer the best cultural fit for succession, but you must verify their proof of funds early to avoid delays. Regardless of the buyer, operating in California triggers specialized diligence. Look at the tight boundaries between these residential zones and industrial warehouses. On day one, buyers scrub databases like DTSC's EnviroStore and the Cortez list for environmental red flags. They audit historical real estate uses and run deep checks on specialized labor classifications for machinists and floor leads to find hidden liabilities. Proactively preparing clean environmental and labor documentation prevents buyers from using these liabilities as leverage to lower the purchase price late in the deal. Valuation is only one piece of the puzzle. The buyer's underlying model determines if you can actually live with the terms of the deal. This flowchart maps your goals directly to a buyer class. On the first path, the clean exit optimizer wants maximum upfront cash and an immediate departure. This requires a highly gated auction targeting strategic buyers. The second path is for the second bite builder, who wants to retain equity for future growth. Here, you target private equity or family offices. And the third path is for the legacy protector, focused on protecting staff and grooming a successor. You prioritize independent sponsors and verify their funding early. A letter of intent is built on financial modeling and legal structure. You have to look past the technical language. Ask yourself one final question. Do I trust this specific buyer to lead my people when I am no longer in the building? Before you take the business to market, align your CPA, M&A broker, and attorney around the specific buyer class you want to attract. By proactively curating your buyer pool, you retain the leverage to set the terms for the company's next chapter.